Okay, with this practice problem, you're practicing a discounted bond. So Valley Company issued 5-year 6% bonds with $100,000 face value. The bonds are dated January 1st, 2012, and call for semi-annual interest payments on July 1st and January 1st. Assume Valley issued the bonds when the market rate was 7%, and the bonds were issued at 95,842. So before we even get into the amortization table, let's figure out how much the discount was. And how did I know that it was discounted bonds? There's two ways of figuring that out. What information is telling us it's discounted?
The percent.
Yep.
The compared percent of the market to like what you're offering.
Correct. So 6% is how much we're offering, right? In interest, the stated interest rate, versus the market, similar bonds are offering 7% interest. So over the life of these bonds, the issuing company is going to pay out 1% less in interest each year than similar bonds would have paid out. So if I'm an investor and I want to purchase these bonds, I want to be offered a discount, right? I don't want to pay exactly face value or above face value because I'm earning less interest over the life of these bonds. The other way that I know it's a discounted bond is the issue price. Issue price is 95,842, which is lower than face value. At maturity, what are we going to pay back? $100,000 face value, regardless of how we issue the bonds. We receive 95,842 in cash. For the first calculation, so determining that discount, what's the calculation? How do I figure out my discount?
It's the face value minus the issued price.
Correct. So I'm just going to move my little thing. Face value of the bonds. And in your homework, or maybe even in the pre-assignment, you may have seen that they gave you two different face values. One of them was the total amount they potentially could be issuing. The other one was how much they actually issued of those bonds. You always want the issued face value. So face value is 100,000. We compare that to our issue price. And
2,804.
Yeah, the issue price was 95,842. And we're subtracting that to get the discount on bonds payable. How much less cash we received when we issued the bonds. So 4,158. On the issue date, 1/1/2012, what's the journal entry? What are we going to debit and what are we going to credit? So I'm going to leave a space.
You debit cash and then discount on bonds payable and then credit bonds payable.
So we're going to debit cash, increasing cash, and how much cash do we receive?
95,842.
95,842. Yep. So we always receive the issue price. And before we get to that next part, we're going to credit what?
Bonds payable.
Bonds payable. It's a liability, right? We have to repay this amount. And what am I going to credit to bonds payable?
100,000.
100,000. So the amount that we record in bonds payable is always equal to face value of the bonds issued. We need more debits to balance, right? And the difference between these is exactly equal to the discount on the bonds. So we're going to debit discount on bonds payable, increasing this account.
That'd be considered a sales discount.
No, it's not a sales discount. It's actually a contra liability account. So it's offsetting against the bonds payable account. It's a sister account to bonds payable, and it's reducing the carrying value of the bonds. And then over time, as we reduce that discount on bonds payable, the carrying value of the bonds is increasing as we're reaching towards maturity. For the first line, January 1st, 2012, why do we start with that date? In the amortization schedule.
That's when the bond was issued.
It's when the bond was issued. So this is the issue date. It's always the first date that we include. And when we issue the bonds, are we paying out any interest on this date?
No.
No. So you're just going to put in a 0 or a dash. And if we're not paying out any interest, have we incurred any interest on the date we issue it? Nope. We just newly released them. So there's no amortization of that discount yet. And for the discount balance, what is the initial discount balance?
4,158.
Correct. 4,158, which is the balance of our discount account. So it's the initial difference between the issue price and face value. For carrying value, on the issue date, it's always equal to the issue price, 95,842. That's a 4, can you tell? How did you do on that first date? Okay. Do you want to move on to the second date? Okay, so 6 months later, we're now going to pay our first semi-annual interest. So for those 6 months that have passed, we're now going to pay out interest. From January 1st to July 1st, is that the same fiscal year? Have we incurred interest in the same period we're going to pay interest?
Yeah.
Yes. For July 1st, the interest payment, we're going to take face value, which was 100,000. Interest that we pay is based on the stated interest rate because that's what we offered, 6% per year. And we're going to multiply, and we're multiplying that times 1/2, or 6 months divided by 12 months, right? Because half of that annual interest is paid in July, half of the annual interest is paid in January. What is my semi-annual interest payment? How much interest am I going to pay out every 6 months?
3,000.
What was that?
3,000.
3,000, correct. What do I know about the semi-annual interest payment? Do I have to calculate this ever again?
No.
No, it's going to be the same for all. We're always going to pay out 3,000. for the life of the bonds. So I could even have this one calculated for January 1st, 17, because I know that every 6 months I'm paying out $3,000. 3,000 on July 1st, 3,000 on January 1st. For the semi-annual interest expense, it's a little bit different in the calculation because we're using the effective interest method. So we're taking into account the market interest rate on the date of issuance, as well as the carrying value. And the carrying value is the preceding bond carrying value. So the bond carrying value at the beginning of the period for this interest. So for July 1st, the preceding bond carrying value is equal to the issue price, 95,842. The market interest rate on the date of issuance was 7%. So 7% per year. And then we're going to multiply it times 1/2 again because it's a semi-annual interest payment. On July 1st, 2012, what is the amount of interest expense that we're going to record?
3,354.
Correct. 3,354. So do you see with the discounted bonds, we're expensing slightly more than we're paying out in interest? Does everybody see that? We're expensing 3,354, but we're only paying out 3,000 in interest. And that difference is how much we're reducing our discount by. We're amortizing that discount, that amount that we allowed them to pay us less for those bonds. And we're slowly going to amortize it over the life of the bonds so that at the maturity date, the discount equals 0. So for column C, this is our discount amortization. The difference between the interest expense that we recorded and the interest that we're going to pay out on this date. 354. Over the life of these bonds, that discount balance is going to slowly be decreasing. So we're going to take the discount balance of 4,158, our initial discount. We're going to subtract the amortization that we took July 1st, 354, to get a new discount balance of how much?
3,804.
3,804. And over time, because the discount's going to slowly be decreasing, base value remains unchanged, our carrying value is slowly increasing by that discount amortization, that reduction of the discount. So we're going to take 95,842 plus 354. And our bond carrying value at July 1st becomes 96,196. Slowly increasing so that at maturity, the bond carrying value equals 100,000, which is face value. Does that one make sense? So part B, what is the entry on July 1st, 2012 to record the interest payment and amortization? So we have one debit and we're going to skip a space for a credit. What am I going to debit on July 1st, 2012 to record this first interest payment date? How do I record interest? So debit interest expense increasing interest expense by how much? Close. How much am I going to debit interest expense by?
3354.
Correct. So column B, 3,354. So notice it even tells us here, column B is interest expense. What am I going to credit on July 1st?
Cash.
Cash. We're going to reduce cash because we're paying out cash on this date. For how much?
3,000.
3,000.
3,000. Column A. We don't balance, we need more credits. We're going to credit which account?
Discount amortization.
There is no account called discount amortization, but close. It relates to the discount amortization. It is coming from column C. What account are we reducing directly related to the discount amortization?
Interest payable.
Discount on bonds payable. So 354. So remember that we have that discount account. So we start with a balance of 4,158, and slowly we're going to be reducing this account balance. So after this amortization on 7/1, the balance becomes 3,804. So we have to directly reduce that discount account. The reason why it's not interest payable is because we're paying out interest on this date. So if it was going to be a credit to interest payable, we wouldn't have this credit to cash on the same date. Questions on that first one? Okay. For January 1st, 2013, we already know that the interest paid is 3,000. You had to calculate the interest expense. And what was my preceding bond carrying value? 96. 196. The market interest rate remains unchanged. It remains at 7% over the life of the bonds times 1/2. So how much interest expense am I going to record on July 1st, 2013?
3,367.
Correct. Slightly more interest than the first one, because our bond carrying value is slowly increasing. How much is my amortization this period?
367.
367. And then slowly we're decreasing that discount balance. So now we're going to take 3,804 minus 367. And my new discount balance is what?
3,437.
Correct. And what happens to my carrying value?
We add 6,000.
Correct. It's going to increase. So 96,196 plus the 367 gives me a new bond carrying value of 96,563. In what period was this interest incurred? What are the dates that this interest that's paid
2012.
out on January 1st, 2013? What period does this relate to?
2012.
2012, right? It's the second half of 2012. The first half we already recorded as interest expense during 2012. The second half of this 2012 interest from July 1st until 12/31 is going to be paid on what date?
The first.
January 1st, 2013. So as of December 31st, we haven't recorded 6 months worth of interest, correct?
Yes.
So what do we need to do at December 31st, 2012? We need to accrue for the interest that was incurred during 2012 but won't be paid until 2013. So if we don't make this adjustment as of December 31st, 2012, our discount on bonds payable would be too high because we wouldn't have amortized the discount until next year. Our carrying value of the bonds payable account would be too high, again, because we weren't amortizing the discount, and interest expense would be too low for this year. It would only account for 6 months of interest, not the full 12. So as of 12/31/2012, we need to record an accrual of interest. So we're going to debit and have 2 credits. What's the debit for? What are we going to debit?
Interest expense?
Interest expense. Yep. So this was from chapter 3. We covered this one. Debit interest expense, increasing interest expense for how much? What column am I looking at?
367.
3,000.
Yep. Column B, 3,367. First credit, because we'll go a little bit different.
Discount on bonds payable.
Correct. Discount on bonds payable. So now we're taking into account the amortization. We're reducing the discount on bonds payable for
367.
correct 367, which was from column C. And the last credit,
Cash.
not cash. We're not going to pay it out until January 1st.
Interest payable?
Interest payable.
Interest payable, yeah. I'm not going to pay out cash earlier than we have to. We're going to pay it on January 1st. So as of December 31st, sorry, that's not a down, it's an up. We're going to credit interest payable, increasing the payable, because now we have an amount owed, $3,000 from column A. On 1/1/2013, what will happen is we'll have a debit to interest payable and a credit to cash when we actually pay it out. So it's a very short-lived payable, but that is the one difference. For Part D, show how the bonds would be presented on December 31st, 2012 balance sheet. So we would have bonds payable, for 100,000 because that's the face value, less discount on bonds payable. So notice that we took the 367 here, right? And the new discount balance is 3,437. Right there. And we're subtracting that from 100,000 to get the carrying value of the bonds. $96,563. Does that one make sense? Okay.
Yeah.
For E, what is the entry on January 1st, 2017 to record the maturity of the bonds? We'll have one debit and one credit. What happens on January 1st, 2017 to the bonds payable account? Will we still have a liability on this date? What do we do on the maturity date?
Pay out.
Pay it all off.
Pay it off. So we're going to debit bonds payable. Reducing bonds payable because we're paying it off for how much? What's the balance? And what's always the balance?
Mhm.
Face value, 100,000. And then we're going to credit. How do I pay off something?
Cash.
Yeah.
Cash. Reducing cash for 100,000. Because at maturity, regardless of how we issue the bonds, we have to pay back face value. That's why over time, that carrying value with discounted bonds is going to be increasing slowly towards face value. Questions on this one? Guys, good? Is it making more sense?
Yeah, it definitely makes a lot more sense.
Okay. Let's take a break here. It's 11. Do you want to come back at 11:10?
Sounds good.
Okay. I'll end the recording right now. If you guys have any questions, let me know. Okay. So we're going to shift a little bit and move to bonds issued at a premium. So with bonds issued at a premium, that means that we're issuing them for above face value. So the issue price is going to be higher than face value. And we're offering a higher interest rate annually than similar bonds are offering on the date of issuance. So we're going to look at this example. They issued the bonds on June 30th, 2018. The face value of the bonds issued was 600,000. The stated interest rate is 10%. Semi-annual interest paid on June 30th and December 31st. Maturity date is June 30th, 2033. And the market interest rate on the date of issuance was 9%. Again, they didn't give us the issue price, so we're going to calculate that in Excel. First things first, what's the term of these bonds? How many years will these bonds be outstanding for?
Like 15 years?
15 years, yeah. So from June 30th, 2018 until June 30th, 2033, it's 15 years. For the issue price, I'm just going to write the formula that we're going to use in Excel. So equals negative present value, so PV, open parentheses, The first number is always the market interest rate. And in this case, because they pay semi-annual interest, so interest is paid twice per year, we're going to take 1/2 of the market interest rate.
4.5.
Yeah. So I'm just going to do this. 4.5% interest every 6 months. So it's going to be 0.045. If you're using Google Sheets, I think you can actually put 4.5%, but in Excel, you need to use 0.045. So remember, with a percentage, you move the decimal point over 2 to the left to get that in decimal format. The second number is the number of payments that you're going to make. So because we're paying interest twice per year, we're going to take 2 times the term, which is 15 years, to get the number of interest payments we're going to make. How many interest payments do we make for this particular bond?
30.
30, correct. And then another comma. The,
30.
yeah, 30.
Wait, can you explain why it's 30 one more time? You said we have 15 payments?
So we have a term of 15.
Oh, I
15
see.
years, yeah.
Okay.
So term is 15 years. And because we make 2 payments per year, sorry, there's a little delay. There we go. 30 payments
Got it.
total. For the next number, that's going to be our interest payment, semi-annual interest payment. So we need to do a little calculation for that. Just move this over here. Sorry. So semi-annual interest payment, face value of these bonds was how much?
$600,000.
600,000, correct. Sorry. And we're going to multiply that times the stated interest rate. So these bonds are paying out how much interest per year?
30,000.
Sorry, what interest percentage per year?
10%.
10, yeah, 10% per year times 1/2 because we paid out semi-annually. So 600,000 times 10% is how much? 60,000
30,000.
times 1/2 is 30,000. Yeah. So every 6 months we're paying out $30,000 in interest.
Ah,
And we're going to put just 30,000 right here. No commas, no dollar sign. What's the last number? What's the last number in our calculation? So right here, we've included our market interest rate. We've included our stated interest rate. We've included the number of payments because that matters for calculating present value. We need to know how many we're going to be paying out, how often.
Face value, right?
Yes, face value is the last number. So 600,000 is included. So comma, 600,000 and parentheses. And then you would push enter. to get the answer.
So you would just put this in like one of the.
I'm going to show you right now. So let me just share. Close that. Okay, do you see Excel now? I'm gonna.
Yeah.
Okay. Just gonna hide this for a second. So I put all of the information in here, the issue date, principal, stated rate, market interest rate. There's the semi-annual interest payment. And then in this formula right here, wait 1 second. I'm not sure why that's doing that.
Professor,
Yes.
when I did the homework, I got it right, but I didn't need to write those on the Excel sheet. I just went on the formulas, and like you have all like PV function, all the functions. So I went under PV function and I only put the numbers and it gave me the right answer. I didn't need like open a new Excel sheet or do anything.
No,
I
you
just
don't
done
need
the
to.
formulas.
You don't have to do everything that I just did.
Oh,
You just need to use this formula and that works. So you can put the numbers. So I'll show you in numbers equals. So sorry, my keyboard's not on. Just give me a second. I'm going to go equals negative present value. And if you don't put the equals sign, then it doesn't start the formula. If you don't put the negative sign, it's going to show up as a negative number for the issue price. Just know that you need it to be a positive number. And then we're going to put in the rate, which is 0.045, comma, number of payments was 30, comma, 30,000 was the interest paid semi-annually, comma, and then 600,000 was the face value of the bonds issued. And then an end parentheses, and I'm going to push enter. So you can see the formula up here, or you can see it within the cell right here. And it's going to show up as 648,866.67, which is rounded to 648,867. I have it formatted to show with the dollar sign. Yours might not show the dollar signs, so don't be surprised by that. Google Sheets will work the exact same way. Apple's version should work the same way, but sometimes it's a little finicky.
So you could just go in and like put it in any row or column as long as you like put the function, put like the equal sign and like the whole.
Correct. Yep, you can put it anywhere. Excel is your friend. You don't even need a calculator when you're using Excel. And the sooner you realize that, the better off you'll be for business and getting hired. My advisory board is telling us they want students to be intermediate or advanced level or higher, basically being able to teach them new skills. So Excel is your best friend going forward. Okay, we're gonna go back in.
How can you do it on a calculator if you have a calculator that has PV?
If you have a calculator that has PV, and I can't remember because I took that class like 20 years ago, but there is a formula for it. I can find it. If you have a financial calculator, there is a way to do it. I just don't remember what the formula is for you. Okay. Let me just write that in there. I lost my pen, sorry. So our issue price is $648,867.
I have a quick question.
Yes.
For the market interest rate,
Yes.
then is it always going to be multiplied by 1/2?
No. So if they pay interest once per year, You won't be multiplying it times 1/2 for the interest payment calculation and for your interest expense calculation.
Okay.
Okay. So if they only paid interest 1 time per year for this example, in that calculation, you would show 0.09. The number of payments would be 15 because you only have 1 payment per year and the term is 15.
Okay.
Interest payment would be 60,000 because that's how much interest you would be paying for 1 year.
Okay.
So it changes the first 3 numbers in your present value calculation. And it also changes what you're calculating down here for interest payment and interest expense each period.
Down there where it's by A, it's a semi-annual measure payment. I think it's like the I don't know, premium. What is a PMT? I'm kind of confused with that one.
Payment.
Oh, just payment. Okay, and
That's
then the stated initial rate, is that, what is that, 10 per year point? Is that 10%? Like, what is
Yeah.
that?
That's a stated interest rate, so 10% per year.
Okay, gotcha. Okay, thank you.
No problem. Okay, so first things first, let's do this. Calculate out that premium. So we know that we're paying out 10% interest each year. Similar bonds we're paying 9%, so we're paying one interest rate higher than similar bonds. We're issuing them at a higher price than the face value, so we know that these are premium bonds. They're going to pay us more at the front because they're going to earn more interest over time. So issue price is $648,867. Face value, the bonds, what we're going to pay back on those bonds is $600,000. So the difference between these two amounts is our premium on bonds payable. How much above face value did they pay us?
48,867.
Correct, 48,867. Are most issuers, most issuing companies trying to avoid this situation? Do most issuing companies want to issue at a discount, not at a premium? Anyone? Why would an issuing company not want to pay out at a premium or issue their bonds at a premium? They're paying more interest over time. But if they're desperate and they need to refinance, and right now the bonds are going to be issued at a premium, they're going to have to do it. But most of the time, they're going to try to avoid issuing bonds if it's going to be issued at a premium. They want to issue bonds when they're at a discount because they're paying less money over the life of those bonds, less in interest. For recording the issuance of the bonds, we're going to record it on the issue date, so 6/30/18. And on 6/30/18, what am I going to debit? What do I receive when I issue bonds? Why do we take out bonds? What's the purpose of it?
Do we receive cash?
Yeah, we want cash, right? We're taking out funding, financing. So we're going to debit cash. Increasing cash. How much cash do we receive when we issue bonds?
6,048,867.
It's always
price.
issue price, exactly. 648,867. So we're not always receiving the 648, but in this case we are, but we're always going to receive the issue price. And we're always going to credit which account?
Bonds paid.
Bonds payable, correct. Increasing the payable, we now have a liability 600,000. And we're always crediting bonds payable for the face value of those bonds that we issued. We don't balance. What's the difference?
The discounts on bonds payable.
Not discounts, similar. Premium on bonds payable, which has a credit balance. So that is the only difference between discounted bonds and premium bonds, at least in the issuance.
I made the same mistake on homework.
It's okay. You won't make it as you keep going. Remember, mistakes are good. We learn from them. So we received more cash than we're going to have to pay back, right? So premium on bonds payable is a liability account. And we have it when we issue bonds above face value or par value. So it's a liability account. It increases with a credit. So on June 30th, 2018, our premium is going to be $48,867. And in our bonds payable account on the same date, we have 600,000. So in my amortization schedule, do you guys want a minute to write this down?
Yeah.
Okay. Take a minute, and it's the same table. There's going to be a slightly different calculation, but we still have our date in the first column, semi-annual interest payment in the second column, semi-annual interest expense in column B. Sorry, it's not supposed to say discount amortization. I made a typo there. Premium amortization here. Premium balance under column D, and then the bond carrying value under column E. Sorry for my typo.
Professor, under B, does it say beginning balance of E times What is
Market, oh, sorry, market interest rate times 1/2.
that? Okay.
Guys ready?
Yeah.
Okay. I highlighted two things. The two differences, at least at this point, between a bond issued at a discount and a bond issued at a premium. So the first part is that when we issue the bonds, we're going to credit premium on bonds payable versus debiting discount on bonds payable, right? Because the discount is reducing the carrying value because it's a contra liability. We issued the bonds for less than face value versus a premium on bonds payable, which is being added together with the liability because we issue the bonds above face value. What needs to happen to the bond carrying value for a bond issued at a premium? What are we going to pay back at maturity?
Instead of adding, it goes down.
Correct. At maturity, we're going to pay back face value of 600,000. We started a number higher than face value, so we need to subtract. That's the only calculation that's different in this schedule. So first date is going to be what date? What's the first date always?
June 30th.
The issue date, June 30th, 2018. Issue date. And on the issue date, do we pay out any interest?
No.
No interest is paid. So we don't have any interest expense incurred as of this date. The premium amortization is going to be the difference again between the semi-annual interest paid and the semi-annual interest expensed, and it's an absolute value. It's just a positive number. These two amounts are zeros, so we don't amortize the premium yet. The initial premium balance is the difference between the issue price and face value, which we calculated above, 48,867. And the bond carrying value equals the issue price. That's our initial bond carrying value, 648,867. The highest the bond carrying value will ever be. Now, if you want to kind of double check your numbers for a bond issued at a premium, if you're looking at these two columns, column D and E, the bond carrying value minus the premium will equal face value of 600,000. It's a check. Versus the discounted bonds, when you add these two columns up, they will equal the face value. And it goes for that all the way down until maturity. What is the next date?
Would it be December 31st?
December 31st, yep, of 2018. So 6 months have gone by and now we incur interest. We've already calculated the interest paid. So for December 31st, 18, and all interest payment dates, we're going to pay out $30,000 in interest. For the semi-annual interest expense, we need to calculate it. 12/31/18 expense. What is the preceding bond carrying value?
$648,867.
Correct, $648,867. And the market interest rate was 9% per year times 1/2 because we're paying interest twice per year. So on December 31st, 2018, how much in interest expense will I record?
$29,199.
Correct, $29,199. So we're going to expense less than we're actually going to pay out because there's the premium amortization right there. The amount of the premium that we're reducing the expense by, because we received more cash up front and we're going to slowly reduce that amount that we received up front, and it's going to reduce the amount of interest expense that we're going to record in our income statement. It's the opposite of what happens with a bond issued at a discount. A bond issued at a discount, you're showing more expense than you're actually paying out in interest. The premium amortization is the difference between these two amounts, positive number always. So how much am I amortizing this premium by? $801. So 30,000 minus 29,199. What needs to happen to my my premium balance? Over time, what should happen to that premium balance?
Does it go to 0?
It needs to go to 0, right? So we're going to subtract the amortization, and my new premium balance becomes 48,066. And over time, my bond carrying value is going to slowly decrease towards face value at maturity. 648,867 minus the amortization of the premium, 801. My new bond carrying value equals
066.
Correct, 066. So if I take 648,066 minus that premium balance, 48,066, what does that equal?
0.
648 minus 48. $648,066 minus the 48,000 equals 600,000. The issue price. It's just a check. What's the journal entry on December 31st, 2018? We're going to have one debit and at least one credit, right? Possibly an extra debit or an extra credit. On December 31st, 2018, what am I going to debit? What am I recording?
Bonds payable.
Am I paying the bonds off?
Oh.
The interest payment?
Correct. So we're going to debit interest expense because we've incurred interest between June 30th and December 31st. So we're going to debit interest expense, increasing interest expense for $29,199. Column B. We're going to credit what on December 31st, 2018?
That's the bonds payable.
Nope, not yet. We're not going to increase the bonds payables.
Okay.
Okay. What are we going to credit? What are we doing? It's a semi-annual interest payment date, right? So we're going to pay out cash.
Cash.
Were you thinking interest payable? Anybody? Why is it not interest payable?
Is it because it
Not
was started in the end of June, not the beginning?
Partially, yes, because the 6-month period kind of falls into that. It's because of the date that we actually pay the interest. In the previous example that you guys were practicing, they don't pay the interest until January 1st, but all the interest was incurred during the prior year. So we had to accrue for that interest at the year end so that we record interest expense in the proper period. In this case, we incur the interest during the same period that we pay it. So we're just going to credit cash because we're actually paying it out on this date. December 31st is the payment date for this one versus January 1st for the prior example. So we're going to credit cash for 30,000 from column A. Now we need more what? Debits to balance.
Debit.
Correct? So remember, and this is a difference, premium on bonds payable has a normal credit balance. So to reduce it, which is what we need to do, we're going to debit that account versus a discount that has a normal debit balance. So to reduce it, it has a credit. So we're going to debit premium on bonds payable, reducing it for the amortization of 801, column C. So the numbers come from the same spot in the table, but the impact to reduce the premium, you're actually going to debit it, not credit the account. Because they have opposite normal balances. So what happens to the premium? Right here, 801 is reduced. And now the premium balance becomes 48,066, the balance, 1231. Does that make sense?
Yeah, that makes sense.
Okay. So in my balance sheet at 1231, (2018), we're going to have bonds payable again, which was 600,000. And instead of subtracting, we're now going to add the premium on bonds payable. Because remember, this is a normal credit balance, so we're adding it. We're not netting them. So the premium balance at 1231 is 48,066. So my bond carrying value at 12/31/2018 equals 648,066. Which is what our table shows. What's the next date in my table?
June 30,
June 30th,
2019.
2019.
Yep, June 30th, 2019. And we'll have 30,000 as our semi-annual interest payment because we know that that's the same amount every period. Semi-annual interest expense at June 30th, 2019 equals preceding bond carrying value. So what's the preceding bond carrying value at June 30th? 648.
066.
Correct. 648,066 times 9% interest per year times 1/2. And how much in interest is going to be expensed for this?
29,163.
29,163. So it's slightly less interest that we're going to expense, right? Because over time, the bond carrying value is going to decrease. So the amount of expense that we're going to take each period is going to be decreased. And the amount that we're going to amortize is going to slowly increase because of that difference. So 29,163 is interest expense, or the difference between interest paid and the interest expensed. 837 for my premium amortization. My premium balance is going to shrink further. So now it's going to be worth what?
47,229.
47,229. And then my bond carrying value is slowly going to decrease as well.
647.
229. Right? And we can go all the way until the very end, but we don't have to. Do you want to record that last interest? So part C, to record second interest payment date. And this is on June 30th, 2019. Remember that our amortization schedule isn't in our accounting system, it's outside of it. So we have to record the journal entries. And we're going to debit interest expense, increasing the expense 29,163. Column B, we're going to debit premium on bonds payable, reducing the balance by 837. Column C, and we're going to credit cash because we're paying out cash on this date, reducing cash by 30,000, which is from column A. And I'll just highlight this again, showing you if that's the difference. I'll also highlight over here, just showing you that you're adding and not subtracting. So do you see that if you understand the discounted bonds, the premium bonds are pretty much the same except for a few minor things? Is this amortization schedule a lot easier than it initially looked like when you looked in the chapter?
Oh yeah. It makes a lot more sense than now, especially after looking at the homework too.
Yeah, and just the more you practice it, the more comfortable you'll feel. And just noticing those differences between semi-annual interest payments and annual interest payments will also make you more comfortable. Do you guys want to practice one?
Sure.
Okay, I'm going to turn off the recording. Okay, so with this one, they issued 5-year bonds. The term was 5 years with a 6% stated interest rate. Face value was 100,000, and they issued those bonds for 104,376. So the issue price was 104,376. Face value was 100,000. The premium on those bonds were 4,376. Did you guys calculate that? On the issue date, January 1st, 2012, how much cash do we receive?
104,376.
Yep,
I mean,
correct. That's right, the issue price. So we're going to debit cash for 104,376, which is the issue price. We're going to credit bonds payable for how much?
100,000.
Yep, face value 100,000. And then the difference between these amounts is 4,376, the premium. So we're going to credit premium on bonds payable for 4,376. Okay, you guys ready?
Yeah.
Mhm.
Mhm. Sorry. Okay. For the first date, the issue date, we put 0 for the interest paid, 0 for interest expense, 0 for premium amortization, right?
Mhm.
Sorry. And then what is my premium balance on this first date?
4,376.
4,376, the difference between issue price and face value. And then the carrying value is 104,376, equal to the issue price. For the first semi-annual interest payment date, July 1st, 2012, you're going to take 100,000 face value times 6% stated interest times 1/2 to get how much interest that they're going to pay out each payment date.
3,000.
3,000. So I'm just going to include 3,000 in each of these dates all the way down this column, correct?
Mhm.
For the first interest expense, what was the preceding bond carrying value?
2,609.
So 104,376 was the preceding bond carrying value times 5% market interest rate per year times 1/2. And you calculated out 2,609, correct? So the amount of interest expense is lower than the amount of interest we pay. We're going to amortize that premium by looking at the difference between interest paid and interest expense. How much are we going to amortize this period?
391.
391. The premium balance is going to decrease by 391 to what?
3,985.
3,985. And what happens to my carrying value?
It's gonna
103,985.
Yeah, it's also going to decrease, and we're not going to include that little calculation there because that's not right. So now it's going to be 103,985. For my first interest payment date, we're going to debit interest expense for
2,609.
2,609, correct, from column B. We're going to credit cash, right, for 3,000 from column A. And we need more debits, correct? $391.
Premium on bonds payable.
Correct. We're going to debit premium on bonds payable. Reducing the premium by $391. So far, so good?
Yeah.
Are you seeing that you're going a little bit faster
Yeah, for sure.
as you're practicing it? For January 1st, 2013, we already have column A done. Interest expense is going to be based on the preceding bond carrying value, which is the 103,985 times 5% interest times 1/2. And we're going to record interest
2,000.
expense of 2,600. Usually your interest expense is not a pretty number. It's just a fluke. 2,600 in interest expense. So our amortization this period is 400. The premium balance is further reduced to what? 3,585.
585.
And now my bond carrying value is reduced a little bit more to 103,585. On December 31st, 2012, we need to accrue for the interest for the second half of interest related to 2012 because we're not paying the interest until January 1st, the next year. So on December 31st, 2012, we're going to debit interest expense for 2,600, column B. We're going to debit premium on bonds payable, reducing the premium balance for $400 from column C. And what am I going to credit?
Okay.
Am I going to pay interest today? I pay interest tomorrow. So I'm going to credit as of December 31st. It's owed.
Interest payable.
Interest payable. Yep. So just remind yourself of this. You're never going to pay interest early, right? You want to keep the cash for as long as you can. So you always pay it on the set dates. So at 12/31, we're not going to pay it. We're actually just going to accrue it and have a payable, an amount owed. So that comes from column A. And that's the only difference when we're talking about accruals. So at December 31st in my balance sheet, what am I going to show? $100,000 is my bonds payable balance because it's always 100,000, the face value. We're going to add our premium balance as of 12/31, which equals 3,585. So at December 31st, we're showing the true value of our bond, 103,585. If we didn't record this final period right here, that's going to be paid out on January 1st, our bond carrying value would be too high. For the last payment date that you were required to do, interest paid still 3,000. July 1st, 2013. What's the preceding bond carrying value? $103,585 times 5% paid per year, or market interest per year, times 1/2. And we have interest expense of $2,590. I'm going slightly faster just because I know that I have a minute left. Is that okay?
Yeah, it's fine.
Okay. The difference between interest paid and interest expensed, 3,000 versus 2,590. And premium amortization is going up as the as we reach towards maturity. So it's 410. premium balance is shrinking, 3,585 minus 410. And what's my new premium balance?
3,175.
3,175. And my carrying value of the bonds becomes 103,175, slowly inching towards face value at maturity. And then the last thing that they asked you to do was to record the payment at maturity. We're going to debit bonds payable, reducing the liability to 0. So we're going to debit bonds payable for 100,000 face value. We're going to credit cash for the same amount face value, because that's what we pay out regardless if it's issued at a premium, discount, or par. So I'm done. I think you guys really understand this. Just practice it. If you're behind in your homework, can you send me an email, please? Because I want to check in with you and make sure that everybody has time to finish it up before the end of the semester. So we still have technically about a month plus a few extra days because I don't have to submit grades until the end of June. So I will work with everyone because I want you guys all to get the points to pass the class, okay? So next class, we will do the study guide.